We have all seen that the stock market goes up and down, and while this appears to be a random fashion, although not totally predictable, there are in fact patterns to this. And understanding where we are in the pattern when the stocks are tanking can protect ourselves and our portfolio from that fear and panic that a market dive can cause. In this video, we're going to take a look at what market cycles are and how they can impact your investments. Hi there, I'm Michelle. Welcome to my channel, where we talk money and having more of it. And in this video, we are going to explain market cycles so that we can understand where we are in the market should the market decide to fall off a cliff, and hopefully prevent us taking some detrimental, fear-driven action that impacts our portfolio. But just to caveat, even though we may understand the market cycle, we can never really know with certainty what's going on in the market. But we can estimate what could probably happen from what has gone before. So firstly, what is a market cycle? Well, simply, it is a period between either two significant market highs or conversely, two significant market lows. And what it does, it looks at what happens to the market during this period, during these two high points or two low points. It's estimated the market cycle between these 2 points lasts 7 to 10 years. And during this time, it's seen to have 4 phases, during which time the market reacts to external economic conditions, which largely drive investors' reactions. Let's take a look at these market phases. The first phase is the accumulation phase. The market has reached a low and it's likely to have bottomed out. It's in a period of extreme uncertainty because while the general economy may be negative with relatively high unemployment, which may still be rising, GDP may be down or even negative, and the news is likely to be just total doom and gloom and full of disastrous predictions, there may still be positive indications popping up unexpectedly. For example, a slight increase in consumer confidence or some other positive economic indicator. This is a phase where typically large institutional investors are building their investments, or brave investors are also opportunistically re-entering the market. It's unlikely to be a great time for you and me, as the market, there won't really be a lot happening, and our investments will tend to be sitting flat and not doing very much. So we may be feeling a bit despondent with the whole investing idea at this point in time, as we probably won't be seeing too many exciting positive moves happening in the market. And we're likely to be hearing a lot of negative commentary from everyone we speak to. So, to prevent us giving up on the whole idea of investing and building our wealth, let's quickly move on to the next phase. The second phase is called the markup phase. And this is where the party really starts to happen and it becomes a lot more fun for us as investors. There are 3 stages in the markup phase. Firstly, the early markup phase. The market's still a little bit boring, but it's much more stable. Redundancy may still be the order of the day in the wider economy, but there are very clear signs of those green shoots of growth emerging in the market. The second stage, the mid-market stage, is where the action really happens. The market outlook is positive, and one would say investors are bullish and jumping into the market. Market prices are rising rapidly, and everyone is talking about investing and building wealth. Greed may be starting to outweigh fear, and this is generally a signal to those more experienced speculative investors that it's time to sell. And the late stage is where the rate of price increases starts to slow, but investors who were uncertain about getting into the market at the beginning of the market stage are now starting to trust in the upward trajectory of the market, and they start entering the market, causing some market spikes at this point in time. And the outlook for the market is best described right now as euphoric. And there is a wide-ranging fear of missing out on the next best thing. It's great fun and everything seems to be on the upward trajectory. So let's move into phase 3. The third phase is called the distribution phase. And this is a bit of a weird time in the market as fear and greed start to compete. Sellers begin to dominate the market, and market prices seem to be hitting against the ceiling. They bounce down only to briefly pop up over the ceiling, and then they bounce down and then they hit the ceiling and tap, tap, tap. The way I'm describing this sounds a bit insane, but select a market index on your phone app, for example S&P 500, and watch what it does, say over a day, a week or month. It's literally like a ping pong ball, either bouncing up, high or low, or just little small bounces over time. Take a look as the motion either accelerates or decelerates. And during this period, investors start to lose some of their confidence and positivity in the market as they start to transition from this euphoric bullish phase to a more bearish viewpoint. On that note, let's move into the fourth phase. I hope my intro there gave you a little bit of an inkling of what is to come. And now in the fourth phase is when things hit the fan and the market crashes. Negativity and bearish sentiments are the order of the day, and long-term investors may find themselves having to deal with the stress happening in the news as they valiantly try to stay in the market and fight their panic as they see the value of their investments tank. A market crash, which is sometimes also referred to as a market correction, is considered to have happened when the market falls between 10 and 20% from its high a year ago. And this can occur over a day or a week. A bear market is a long sustained drop in the stock market of over 20% from its recent high. A market dip, on the other hand, is a less serious drop in the market after there's been a sustained period of upward movement and then it just drops by 2 or 5% for whatever reason. In the last 100 years, we have seen 5 significant market crashes. The first in 1929, which saw the market drop 48% in 2 months, triggering the Great Depression and leading to the point in 1932 where the market dropped 89% from its high in 1929. And it literally took 23 years to regain that high. The second major crash occurred on the 29th of October 1987, and it's known as Black Monday. The Dow Jones Industrial Index in the US fell 23% in one day. But barely a year later, it had recovered as the government implemented the actions that it had learned during its mistakes of the 1929 crash. 2000 saw the dot-com crash, where the US Nasdaq dropped 77%, resulting in a loss of billions of dollars and causing a wave of technology companies to go bankrupt. And it took 6 years for the market to recover, only to be hit by the global financial crisis in 2008, where the seemingly bulletproof financial institutions such as Lehman Brothers and Bear Stearns collapsed. The FTSE 100 fell as much as 31% in 2008, and the global economy headed into a recession. But governments quickly intervened again, and by 2012, global stock markets had somewhat recovered. However, in 2017, the US government cut corporate taxes in the US, and that basically set the US market on a speedy bull run. It seemed the upward trajectory of the stock market was a given until March 2020, when COVID brought the entire globe to a halt. The S&P 500 dropped by 31%, and it seemed absolute doom and gloom was about to enter global sentiment. However, once again, swift government action, the transition to a largely e-based global economy, and years of technological advancements being advanced by unprecedented speed, was rocket fuel to the stock market, which 2 weeks later started an unbelievably sharp recovery. So I guess from that point, or that high point, the good question to ask is, how do these stock market crashes or corrections happen? And just to reiterate, they're almost impossible to predict. But if you look back in the rearview mirror, they are typically preceded by an extended period of stock market price increases where everyone is overly optimistic, spending is the order of the day, and it usually leads to increased borrowing. And the crash occurs when all this exuberance is generally interrupted by either government action or some other geopolitical, socio-economic, or macroeconomic event. So if we're at a high point, we know that the market is going to go down at some point in time. And so the next question to ask is, how long will this last? Because you certainly don't want to find yourself caught out in a 1929 kind of scenario where it takes 23 years for the market to recover and literally have no ability to be building wealth by being invested. So again, while it's impossible to say how long a stock market correction will last, we can again look at history as guideposts. And in the last 4 corrections since 2008, the average decrease was around about 15.3% and lasted approximately 3.5 months. Bear markets like to hang around a little bit longer, and since 1987, the average decrease has been about 48.5% and has lasted around about 1.4 years, which isn't too bad when you consider the last 3 bull runs have lasted 9 years. So the good news is downturns are sharp and fast, while upturns play out over a much longer time period. How does this overall crash impact the various sectors of investment? Well, the various assets within the stock market in fact respond differently to a crash, and assets outside of the stock market even have their own cycle. For example, the property cycle is estimated to be 18 years, with 14 years of growth, 4 years of stagnation, punctured by a final decrease. This means when it comes to preparing for a market crash, diversification across asset classes, industries, and geographies is your friend. Now, as regards looking into the stock market, when the market is going up, luxury goods benefit as people indulge in buying expensive things like cars and motorbikes and expensive electronic items. Conversely, when the market is going down, consumer staples tend to outperform as people cannot cut back on the necessities. Toilet paper is a less obvious example, judging by our recent pandemic. So, what should you do to prepare for the inevitable market crash? Firstly, as I said earlier, diversification is a must. Secondly, when the crash happens, do nothing. Now this sounds easy now, but when the market is crashing and so is the value of your investments, it's mighty tempting to sell and preserve as much capital as you can with the view to getting back into the market later. Well, countless studies have shown this is not the optimal approach. It's time in the market is what wins, not timing the market. And the market's worst down days are followed by its best up ones. And if you are a long-term investor, your strategy is to be in the market for the long term. And history, although not a guaranteed indicator of the future, does give us some guidelines as to what may happen. It has shown us that markets go up a lot. So the longer you're in the market, the more chance you have of benefiting from this. Just think about this. In the last 90 years, 75% have been growth years. 25% have been decline years. You literally cannot afford to risk missing out by evacuating the market. Bottom line, understand the market cycles so you can recognize what may be happening at any given point in time. And understanding this means you can manage your emotions, your potential panic and desire to jump ship when the market's down, so you can hang in there for the long haul. And literally, you will be so pleased you did. For more talk about the markets, money, and other things that build a wealthy life, please pop over to herwealthiq.com and sign up to my newsletter. If you like this video, please let me know by liking it and share it with any other ladies who want to change their financial story. And for financial education and money talk designed for women, please subscribe to my channel. And thank you very much for watching my video.